Hey, what's going on, guys? Welcome back to the Growth Mindset channel. So right now it's currently February of 2020 and I want to make a video on personal home taxes because around this time, if you're making income or you own a personal property, it's good to know a little bit about what you can write off in deductions for just owning a personal home. So in this video, we'll go over 5 main things you can deduct or at least claim on your taxes for every single year that you own a property. Also, it should be noted I am not an accountant and I'm not an attorney, so I would recommend looking online for more verification and information about these topics. In this video, it's really just to give you a guideline and start thinking about what are the things you can write off, and then you should go online and verify how you can actually make this happen. So the first thing is, it's the most obvious and the most easiest, is that if you have a lien on the property, or essentially a loan on the property where the bank is giving you money, lending you money to pay down a home over 15 or 30 years, you can write off the interest on that property. So the key thing to remember is that if you purchased a home before 2017, the largest loan balance you can have and still write off the interest on that property was $1 million. So if you bought a home that was over $1.0 million, you couldn't claim all the interest or up to a certain value of interest on that loan. Now, if you purchased a home after 2017, you could claim interest on a loan that was up to $750,000. So the IRS changed how much money and how big of a loan you can qualify to write off the interest on that property. So that's the first one, writing off interest on your home loan. And to keep in mind with this is that you can write off the interest paid in points to pay off the loan balance, not the fees associated with refinancing for another loan. Number 2, property taxes. If you're married, you can file to claim up to $10,000 in property taxes. If you're single, you can claim up to $5,000 in property taxes. Number 3, this one's a little more unique and you probably, or most people would not know about it, is that if you use a HELOC, which is a home equity line of credit, and it's basically where you take equity out of your house and get another loan with it. If you spend that additional loan on improving the condition of your home, you can also write off the interest accrued on this HELOC. Keep in mind though, that when you're doing a HELOC, the interest accrued can only be deducted up to a value of $10,000. So it's in summation with the personal loan that you already may have. So if you have a personal loan and you deduct interest of $7,000 in your HELOC, you gain $4,000 of interest, you can only claim up to $10,000. So that extra $1,000 you just have to absorb because you can't write it off, according to the IRS for this year. Number 4 is selling costs. These are fees associated with paying for a realtor or a broker to help sell your property. So to include with that, anything that's involved with marketing, inspection fees, title insurance, and escrow can also be lump summed into the selling cost fees, which can be written on your taxes. Number 5, the best one that I recommend, if you own a property for a total of 5 years and you lived in it for 2 out of the 5 years, you can sell the property and not pay capital gains. Now, this is called Section 121 in the IRS, and essentially if you own a property for 2 out of the 5 years, or you live in the property for 2 out of the 5 years, doesn't matter if it's 6 months and you rent it out for a year and then another 6 months, as long as if you can prove that you lived in it for 2 years out of those 5, any profit you make off of that, you don't have to pay capital gains on. So I would highly encourage that if you own a home for quite a while, in 5 years, and you rented it out or you just lived in it for that long, you can sell it and not pay anything for the profit. Now, keep in mind though, with Section 121, there is a cap. So if you made a profit of over $500,000, then you start getting into capital gains again, but it's basically an exclusion. So if you were married and you made $500,000 or below in profit, you don't have to pay capital gains. Now, if you're an individual that sells a home, you can claim up to $250,000 that avoids capital gains tax on that property. Alright guys, that's all I got for you. Those were the 5 quick things on benefits of writing off taxes for your personal home. Let me know in the comments below if there's anything I may have missed or you suggest doing that you might be familiar with from the IRS. Thank you guys so much for watching the Growth Mindset channel, and I'll catch you guys all on the next one. Bye.